Welcome to Vegas Realty Check, your go-to podcast for all things Las Vegas real estate. Whether you're buying, selling, or investing, we bring you the latest market trends, insider tips, and expert insights to navigate the ever-changing Las Vegas realty landscape. Tune in each week as we break down the data, answer your questions, and help you make the best real estate decisions in the entertainment capital of the world.
Hey Las Vegas, thanks for joining us back here at Vegas Realty Check. I am Trish Williams.
And I'm Courtney Boehm, your co-host.
Yes, and we are here to bring you the news. Today we're going to be talking about market stats and buyer goals for home ownership. So it's going to be a great show. Hope you stay tuned in. And let's get started with our market numbers for the week.
Yes. So right now, single family homes on the market are 5,032, which is down 95 from last week.
We see that inventory is going away, guys. It's moving down. So that's good. Condos and townhouses, those are down huge, 554 at 1,283 for the week.
So are they being bought up or?
They must be being bought up, but that is a huge jump. I had to double check that number because I was like, this doesn't even seem right. So those are down quite a bit.
That is a huge jump.
Yeah. And then we are at our 7-day stats. New listings are at 936.
Which is 46 more than last week. So not a crazy number, but we're definitely seeing a little bit more listings come on market, especially getting into the new year.
Yeah. Price decreases, those are hovering around the same number, but it is a big number. So with 791, that's up 6 from last week. So sellers are, and this is a word to you guys for sellers, like our numbers are showing movement now. If your home is not moving, look at the price. It's price or condition. There's no other explanation.
Just price too high.
Yeah, it's either price too high, it's not showing well. Definitely, this is the time and the market to look at those price reductions to make sure that you get your home sold.
Absolutely. And we have 606 sold this week, which is up 86 from last week.
That's a good sold number. So yes, those numbers are looking good. And 819 in contract, it's down 10 from last week, but that's a really good in contract number.
I wonder how many of those solds were people from California.
Yeah. We are hoping we're going to start seeing some Californians move out here to Vegas, which they've been doing, but we're expecting that that's going to raise over the coming months.
Absolutely.
Where are we at with rates this week?
So yesterday, actually, we were finally under 7, which
Yay!
we haven't been under 7 since December 17th on a 30-year conventional. So it did come down a little bit, and then about an hour ago we saw a little uptick. It went right back to 7. So the market is definitely holding steady, and we're sitting right at about a 6.4% on an FHA VA on our national average. So I do think we're going to be right around a 7%. I don't think we're going to see too much movement either way February, but I think once we hit March, when the feds meet, I do think that's going to come down. So we're at a 7%, about a 6.4% for an FHA VA. But it was good to see it come down, and then it came right back up just a tad bit today.
Yeah. 6.4 is looking good, though. So
Absolutely.
Those FHA and VA loans are looking a little bit better. And we have some news for the week. Las Vegas sales in January broke records.
Yes. So there was an article in the Las Vegas Review-Journal that home prices in Las Vegas broke records in January. The median price of houses sold in Southern Nevada was $485,000, which is the highest ever recorded since May of 2022.
Yes, and that's a 9% increase from last year. So that is huge. That is huge. We are definitely holding steady in our market. The talk of a crash, I don't think is even in conversation anymore. We are definitely holding very well in our market right now. So things are looking good, at least for next few years, I think. You have a loan program to highlight today,
Yeah,
Courtney?
so today we're going to talk about the FHA loan. This is one of our most popular traditional loans.
Okay.
The other loans that we typically see the most going through, the standard banks are going to be your conventional, your VA, and then your FHA. So an FHA loan is through the Federal Housing Administration, and this loan is really going to be geared towards, not always, but typically your first-time home buyers, and then also people sometimes that have a little bit lower credit scores, higher debt-to-income ratios.
Now, I've heard some people say FHA, they think it stands for first-time home buyer.
No, but
it does not.
But not always. When you're looking at FHA, usually we're looking at debt to income, credit scores. Typically, if we're looking at conventional side, it's going to be someone who has lower debt to income. They have usually a pretty decent or higher credit score. When the rates are high, we typically will look at both just to kind of see what's going to be best. However, an FHA loan can only be used for a primary residence.
Okay.
So it can be up to 4 units, but one of them has to be occupied by the actual borrower.
Okay. So you can buy a fourplex with an FHA loan.
Absolutely.
Yeah.
And
that's a great option.
And we'll look at rental income and things like that to also qualify the loan.
Okay.
So that's kind of nice.
That's a good option for people. And what would you say is the biggest downfall of FHA? Because the rates are better. It's primary. It has to be owner occupied. But what would be the biggest setback that people have with an FHA loan?
So there is going to be mortgage insurance that is included in the actual loan.
Okay.
So you're going to have mortgage insurance that's due at closing, whether it's rolled into the loan or paid up front with cash. It has to be one or the other, but there is a premium up front, and then it's also built into the loan.
Okay.
So with that, on an FHA loan, you typically can put down 3.5%, which is great to get your foot in the door to a home, especially for a new homeowner or maybe someone that doesn't have a ton of money saved.
Yeah.
That's a great benefit. But with that does come mortgage insurance that is rolled into the payment. And so we have to look, of course, at affordability. Now, if you put 3.5% down only, you're always going to have that mortgage insurance built into the loan. It will not go away.
Okay. So what is the percentage that you can put down on an FHA loan to not have mortgage insurance, or is that existing?
So on an FHA loan, very different than a standard conventional loan, which I will get into next week. We can do the conventional, but on an FHA loan, you will never not see it unless you put down 5%.
Okay.
So on 5% or more, it will go away after year 11.
Okay.
Most people...
I didn't know that.
Yeah.
I didn't know that it went away.
Yep. Most people refinance out of an FHA loan.
Yeah.
Especially because the rates come down. Most people, especially here in Nevada, either don't stay in a home for more than a certain amount of time. Usually it's very rare you see someone stay in a home for, not always, but most people are going to refinance out of that and go into conventional loan just because then they get rid of that insurance. It's pretty rare you see someone hold that for more than 11 years, but it does happen. But with that, a couple things. FHA, we're always going to look at your standard income. You do have to have qualifying income.
Yes.
And we're also going to look at debt to income ratios. Very different than a conventional loan where your typical debt to income can be a tad bit higher. So the max is about a 56% versus a conventional loan where it's 50% debt to income. So you can have a tad bit higher, and credit scores can be anything under 580 is usually going to be a hard loan to get qualified, because typically under 580 you're having some other issues, a bunch of disputes on credit, or you're just not paying your bills. If your credit is 580 or under, it's automatic 10% down.
Okay.
If it's above 580, it's 3.5%. So of course you can put down more just to make it more affordable.
Yeah.
And then we're also going to look at, have you not paid your taxes and things like that, student loans. So those type of things are going to come into play with that. Like I said, most people do come out of an FHA loan though. So just statistically, if you're looking at like a $500,000 house, the average, if you're just putting the minimum down, like a 3.5%, you're looking at about $17,500.
Yeah, which is definitely a very easy down payment to come up with.
Absolutely.
So that is it is a great option. And what are the loan limits on FHA?
So FHA this year is $524,255. It's up about $25,000 from last year, which was sitting right around $498,000 for a single family residence. And the nice thing about an FHA loan is it can be a gift fund from like your family, parents, 100% of that, and then also 6% 10% of seller concessions.
Okay, so it does give new home buyers the option to be able to get help, take gifts from their parents, to be able to, or from anybody, and be able to get into that home ownership. And speaking of a goal of home ownership, so we had a great question from Vanessa, and I think we can just focus the rest of our show around that question because I thought it was great. So Vanessa says she has a personal goal of buying her own home. Many people say that right now is not the right time. How does she know when it's the right time? And while she's preparing, what are things that she can do to improve her credit and save more for when she does buy? Any advice would be appreciated. So that's a lot of a question. So it's a few questions rolled over in one. Yeah. But I think when I was looking at this, like the first thing that came to my mind was goals and how important goals are. I'm always I'm a goal setter, and unfortunately, this year, right, we're in February, I still have not set my goals for 2025, which I'm working on. It was just last year was such a big year, so many things accomplished. I kind of put it off, you know. Yeah. But I think setting a goal is like creating a GPS for you. You know, it just gives you direction of where to go, and you set out a game plan step by step, and that will help you to achieve that goal. And as far as like growth, like wanting to own your own home, it's growth. It's a way, it's a path into wealth and building wealth. It is, you know, my daughter bought her home at 22 years old, and she's, you know, she was working at a restaurant. She's not, you know, making income where she would be able to save a lot of money over the years. But now, today, she has over $200,000 equity in that home. That's a lot. That's wealth she would not have been able to build on her own, but she was able to build that through her home.
And how long has she had that house for?
She bought it in 2018. So what were we, 19, 20, 7 years.
And that's a lot of equity.
That is a lot of equity over 7 years. So yes, this is a great goal to have. And one thing that, an analogy that I use often, even when talking to my kids or talking to anybody about goals, I heard years ago, and I can't quote the source because I don't remember where I heard it from. But
well, you still remember it. So.
I still remember the analogy, but not the source. But we're all living beings, like plants. Plants are living beings, right? So picture yourself as a plant, and a plant in a pot. You know, when a plant starts out in its pot, you give it food, you give it water, and it will grow. But it comes to a point where that pot becomes too small for the plant, and the plant has to grow out of the pot. Taking it out of the pot and putting it in a bigger pot is going to cause it to struggle. It's going to look like it's dying for a little bit. It's going to have a hard time adjusting, but it's necessary, because if you leave it in that pot, its roots are going to grow too big. It's going to start breaking the pot all around it, and eventually it'll either strangle itself or just die. And I hate to sound so dark there. You're just going to die if you don't grow. But that's how important growth is in our lives. And I believe that homeownership is a part of growth.
I really like that analogy.
Thank you.
That's good.
Thank you. It's one of my favorite ones.
Yeah.
Yeah.
I think to always have goals and be driven to, you know, get out of maybe your comfort zone or do something different, and goals are important, especially writing them down and having a vision for what you want. And I think, especially being in our industries, we can say that buying real estate is never a bad idea.
Yeah. I think if you went to any of your grandparents, for instance, and ask them if they regret buying the home that they probably had forever now, it's never a bad idea. It's never, in the long run, you just think of all the years and all the money that you can put into paying rent that goes absolutely nowhere, and what that could do in your equity and building value over time. Sometimes it's not instant. You know, these last couple of years, appreciation has been happening a lot slower. Yeah. Sometimes it is instant. It's whatever the market's doing. And there's even times when the market goes backwards. And the biggest tip I can give you for that is you just hold steady. It will come back. It's always come back. Historically, it's always come back.
And I think the biggest thing too, especially in a market like right now, is worst case, let's say a couple years, maybe your home doesn't build a ton of equity, which especially in this town right now with everything going on, which I'll kind of go over that in a moment and we'll tie that back in. But I think even if, let's say you're not building equity that moment, at least you know what your payments are. Yeah. Because there's so many people I know of that are renting and all of a sudden their rent goes from $2,000 to $2,400.
Yeah.
And now it might not be affordable, or now they're spending all this extra money and it's just gone.
Yeah. Yeah. And that is locking in your payment. Also, the benefit of if rates come down or when you build up enough equity, refinancing and lowering that payment. Home ownership is the only thing that gives you the option to make that payment lower over time instead of it going up. So that is another thing. And going into what things can she do to help get ready?
And I'm gonna cover that in just a minute, but I also wanted to kind of just touch on a couple highlights as far as this market.
Okay.
I think it's super important that if you find a house that matches all your, your boxes, it might not be the perfect home forever or your forever home, but if it's something, if you get a pre-approval and it's something that's doable and affordable, you can always refinance. And I think that there's some things that, as far as Nevada goes, that we're the number one place for investors that are buying housing right now.
Yes, I believe that.
So in the entire country, we are the number one place. Investors are coming and they're buying a lot of properties. We have some things coming to Las Vegas. Sony's coming and the Warner Brothers studios are also coming here. Mm-hmm. So what that means is a lot of those companies are coming here with a lot of money. They're buying a bunch of properties because when their employees move over here, they're going to rent them out to their own employees and they're going to make money off of it. They're going to capitalize. So I think when you're looking to buy a home, unless you have infinite amounts of money to put down, you don't want to be in a situation, which we touched on last week, where you're in these bidding wars and these people are coming in with a bunch of cash.
Yeah. Yeah, absolutely. And there are markets like that. We've been in markets like that recently.
Absolutely.
And there are markets like that where you have to have more cash out of pocket to be able to get into home ownership. And that's a great point.
And I do think the best time to buy is when you're ready to buy. When you're ready, if you financially have the means mm-hmm. and you feel like it's something that's doable. But as far as credit goes, or getting, I think the question said, what can I do to improve my credit and save more? So there's some things we always talk about not doing before you look at purchasing a home. So I'm going to cover those and then some of the things you want to be careful of or not to do. The biggest thing is really looking at, don't open new credit lines.
Yes.
That's a huge one. Just don't.
Now on that, I have a question though. Mm. Often I've heard people say that they were told that they should have a credit card to build credit. So what would you suggest for that?
So it's going to depend on where your credit is. If you have virtually no credit, that's one thing. And I do think it's important based on your timeline of looking at a home. Sometimes we can kind of do a pre-approval and give a brief overview of what we need to do to get you where we need to in a certain amount of time.
Okay.
Very rarely, not very rarely, but I'd say half the time people come and they want to get approved and they're not ready to buy a house yet.
Yeah.
But they want to have a roadmap on steps to get there.
Right.
And so I think that's important to look at overall debts and where you're at as far as income, so we can kind of put you on a road to get you to home ownership. If you have virtually no credit, then you want to open credit.
Yeah.
Because that'll help you build credit. And we have seen people and there are situations where there's families that just buy everything cash.
Yeah.
And so it's not that their credit is bad, they just literally don't have credit.
Yeah, they just never built credit
yes.
lines.
And
yeah.
so in that case, we're going to have a different conversation of let's get you some lines of credit going. That way we can start establishing credit.
Right.
If you have no credit, that's a whole different conversation. If we're looking at how can we improve credit scores and what to do to prepare for purchasing a home, one would be, paying down your debts.
Yeah. keeping that balance, your overall balance under 30%.
Yep.
Is the golden rule.
Yep.
And some people have credit cards that, they may have a credit card, they paid the balance off to zero, and then they just don't use it at all. And when you're trying to build credit, even if you add your Netflix account to that and then pay it every month, it will report. And as long as that is continuously reporting, you're continuously improving and building your credit score.
Absolutely.
So you don't have to go on a shopping spree, and you don't have to put yourself in debt by using that card, but continuing activity on it can help build your credit.
Absolutely. And a lot of people don't know you don't want to close a credit card line.
No. Yes.
You don't want to, for the simple fact that when you're looking at credit, about 15% of your credit score is based on your history of credit.
Yes.
So if you've had a credit card for 15 years and you maybe never use it, which goes back to the point of you want to use it, even if it's something small, $10, when you close it, it actually does negatively affect your credit.
Yeah, because it's the time of history of having that account. I had an old Mervyn's account, like Mervyn's. It was around. Now they're all Kohl's, and then it transitioned into Kohl's, and But the thing is that the history of that line of credit is so long that it reports very well. And I rarely ever shop at Kohl's, but when it comes, I think it's every 2 years or something, they say, we're going to close your account if you don't make a charge. So I'll make a charge just to make sure that it keeps that line of credit going.
The more revolving credit you can show and the least amount of utilization is what's going to help build your credit. So if we're looking at building credit as well, or getting your credit score a little bit higher, not closing credit, obviously credit accounts, and then also recommend just don't spend on things that you don't need, right? If we're really trying to focus on getting your debts down and getting that utilization under 30%, we all go to Costco and are there for 2 things and end up with 20 different things. So really try to pay down those balances. And I typically recommend, if someone has high credit card balances, we're going to look at which one's the highest and try to pay that down first so we get that utilization under the 30%.
Right. And I think it's a good rule of thumb, if you're out and you're about to make a purchase, I always think it's a good idea to have a savings account. Everybody should have reserves and funds. If this purchase that you're making is higher than what you have in reserves at that moment, then it's probably not a purchase you should be making, because you should not buy anything. Say if, just for instance, say you only have $1,500 in savings, and you're out looking at a TV that you want to buy that's $2,500. I would say no. Don't do that, because
I would say no too.
That purchase is higher than the amount that you have saved for reserves, and it's not a smart or wise purchase. I would definitely say, if you're going to do something like that, or you're going to purchase something like that, it should never exceed the amount of reserves that you have already saved, because you have proven to yourself that you can save that amount or put that amount aside. And if this amount exceeds that, then it's probably setting yourself up for failure.
Absolutely. And I think when you're purchasing a home, you want to have a tad bit of cushion for things that maybe need to be fixed, minor things, or, right when you move in, obviously there are going to be expenses, movers, and you might need new furniture and things like that. So you really want to look at that. I also advise too, if you're, a few months away and maybe not ready to do a pre-approval yet, freecreditreport.com, you can get a free credit report once a year. I believe it's once a year. And you really want to look through that. Statistically, 79% of people's credit reports have something inaccurate.
Yes. And let's talk about that for a second. Disputes. So opening disputes on those credits. Back when I purchased my first home was a townhome. It wasn't my dream home by any means, but it got me in. And when I sold it, I had equity that I was able to put down on the next home. So it was fine. And I knew and I understood that I wasn't going to get into my dream home first. I just wanted to be in home ownership.
And that's the important thing when you're buying a home, is this is a starter home most of the time. So let's get you in first.
Yeah. But back at that time, I did have some inaccuracies on my credit report. I had to fix some things before I was ready. I was young, and there was some stuff there, but some of it was not accurate. The dispute process back in that time was very difficult. I had to send letters. I had to, do a lot of emails and faxes. Those fax machines were really old school now, but all of those things to get it done. And now the dispute process is simple. It's like a click of a button to dispute something on your credit report. They look into it. So
it is. Disputes can be very tricky when getting a loan closed. So that's why we typically advise we're going to look over your credit report and see what's on the credit report. Disputes, the process has become easier, but you don't want a bunch of disputes on your credit when closing a loan. Typically, the wording has to be changed and removed.
Okay, so the disputes, if you have an open dispute, they need to be resolved before you're doing your purchase.
And there has been times where someone's credit is not the highest and they go to dispute, and a lot of times it does change your credit score because now something is changed on your actual credit report.
Right.
So that can be a little bit of a tricky process. And that's why it's so important to have steps and have a roadmap. And if you're wanting to buy a house, in the next 3-4 months, you want to get a pre-approval so we can start guiding you towards what needs to be changed, fixed, or done. It is a little bit of a process sometimes.
And even if you feel like you're not quite ready right now, Vanessa, it is a good idea to talk to a loan officer. Call Courtney and get this started so Courtney can help lay out a game plan of where you need to go and what you need to do to make that happen. Doesn't have to be today, and we understand if you're not ready today, but setting that out for you can help you have clarification on where you need to go with that. And then saving money. Saving money is always hard, right?
It can be.
It can always be hard. I learned many years ago, I did the Dave Ramsey Financial Peace University. And then my husband and I took it a few times because we just really had to absorb and go into it. And it was hard because a lot of it is, when you're in bad spending habits, a lot of it is curbing that, and it talks about it. If you really follow the plan, it's not easy and it's uncomfortable, but you do have to kind of change the way you live. And that was a big thing. But one of the biggest things that we took away from that was the importance of saving. Learning to live off, I mean, we're now at 80%. We've gotten in the habit of learning to live off 80% of our income because we do tithing for 10 and then we do savings for 10. But regardless of that, learning to live off at least 90% of your income. And right when you get that check, that payment, 10% goes immediately before you touch it. Before you pay a bill, before you do anything, that 10% is automatically moved into a savings or reserves account. And that is a hard habit to get into. And sometimes you look at, well, this isn't going to work because I have this, and that. It has to be, you act as if it doesn't exist. You put it away before you touch anything, because if you put it away after you pay all your bills and you say, oh, I have this much money left to spend, and then you make that Sam's Club or Costco trip and It's gone. Yeah, and Target, it's gone because you see it in your account, it's there, and then that money that you say I'm going to leave over for savings is already spent, and then it never goes there, and you have good intentions, but it never happens. Putting away that 10% first and getting it reserved to the account and then working with the rest of the money is what it is. A very good discipline and very good habit that everybody needs to get into.
Absolutely. And another thing that I always advise is, and I can't tell you how many times I've seen this when purchasing, someone will buy a new car right before and the payment is high, and it literally disqualifies them from their debt to income being, something that we can qualify. So be really cautious of when you're purchasing a car, the payment, your income. And if you're looking to buy a house, I mean, I've seen so many times a car just...
Cars are depreciating assets. They do not appreciate in value.
And the payment does hit towards your debt to income. And if the payment's $1,000 a month...
Yeah. And you really should. There's a saying out there, buy the house before the car. And that really is really is a good rule of thumb as well. You know, you don't have to have the best car or the newest car. A car is a means of transportation. Definitely want something that's reliable, but it does not have to be a brand new car to make it reliable. And when you're talking, you know, flashy, some people want a flashy car. It's going to impress their friends. And really, it's a lot more impressive over time that you're building your own wealth.
Absolutely.
You're impressing yourself. You're setting up your own strategy, because there are so many people that are in apartments right now with some really amazing cars, but they are not building long-term wealth.
So wait until after the house closes before you get a new car, or you take out a large loan that's possibly could disqualify you from qualifying for a loan.
Absolutely. I think those are all good tips, Vanessa. I hope that helped. And yes, if you are watching our show, please go to our website, which is our link tree at www.realtycheck.vegas. Like, share, subscribe, tell your friends about us. And we do want to send a shout out to our marketing partner,
Yes.
Chicago Title. Thank you so much for your support. And we will be here next week. How do people get a hold of you, Courtney, if they want to talk about
Absolutely. So 702-416-6918 or see Boehm at jfkfinancial.com.
Okay, and I'm Trish Williams. You can reach me at 702-308-2878, and together we can get you on this plan and towards your goals. And hope you enjoyed the show, and we will see you guys next week.